Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Palantir Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And for Palantir, the story really remains this dramatic conflict between flawless operational execution and a historic, almost unprecedented valuation.
That is the perfect way to frame it. I mean, when you strip away the noise and just look at the actual numbers they delivered for Q3 2025, they were magnificent. We're talking about record revenue hitting $1.81 billion, which is a massive 63% increase year over year.
And the quality of that beat is so crucial. They didn't just, scrape past the estimate.
Not at all.
They demonstrated superior efficiency. Revenues sailed past consensus by over 8%. And adjusted earnings per share were, a staggering 25.5% better than analysts expected? When a company is executing this cleanly at this scale, it really commands attention.
And that performance, naturally, it gave them the confidence to significantly lift their outlook.
Yeah.
They raised their full-year revenue expectations to between $4.396 and $4.4 billion. But what's maybe the most important detail for investors?
I think I know where you're going with this.
Yeah, for those who still associate them with, startup volatility, it's their projection for 2025.
Exactly. They are now expecting GAAP operating income and net income in every single quarter of 2025.
Every single one.
This isn't just adjusted profitability anymore. This is consistent, genuine profit under standard accounting rules. That shift, it changes the whole conversation.
It does.
It goes from a speculative growth story to a high-quality scaling software giant.
So we have to ask, what is powering this sudden steep acceleration? Historically, Palantir was defined by its relationship with government and defense, but the real catalyst now, it's the commercial surge.
That's the engine, no doubt. The U.S. market now drives about 75% of their total revenue.
Right.
And that overall U.S. revenue segment grew 77% year over year.
Right.
But if you drill down into the U.S. commercial, the non-government slice, the growth rate is just stunning.
What are we talking about there?
A 121% increase year over year.
121%. I mean, that is the fastest expansion rate in the company's history, and it's pretty much entirely attributable to the rapid adoption of their artificial intelligence platform, or AIP.
Right, and this platform isn't just selling software, it's selling immediate transformation. The market is finally starting to get how their go-to-market strategy works.
Especially with AIP.
Yeah, traditional enterprise software sales. That can take months, sometimes years, of negotiation and integration. Palantir has completely bypassed this using what they call boot camps.
And for anyone who hasn't looked into these, the boot camps they're essentially these hyper-intensive workshops where Palantir engineers physically go into a company.
Right, into the trenches.
Exactly. A manufacturing plant, a financial firm, whatever. And they spend a few days showing the client how to solve a deep, complex, mission-critical problem using AIP, often with the client's own data.
It's a genius sales strategy.
It really is.
Because it proves the value proposition instantly, instead of just promising it. This model has brought over 1,000 companies into the fold so quickly.
So they're converting interested parties into paying customers in days or weeks, not quarters.
Exactly. That velocity is what's justifying the premium.
And you can see the proof in the contracts. They closed 204 deals worth over $1 million. And get this, 53 of those were over $10 million in value.
Wow. And the total contract value.
It hit a record $2.76 billion. That's up a massive 151% year over year. These aren't small pilot projects. These are multi-year sticky commitments.
And those contract wins really highlight how versatile the platform is. It's so easy to just think of Palantir as a defense or intelligence tool. But look at some of the recent partnerships. Take Fedrigoni, a global specialty papers manufacturer. That's a fundamentally traditional, old-school manufacturing sector.
That's a great example. Why is a specialty paper company partnering with a sophisticated AI platform?
Well, they're using it for their digital transformation.
Yeah.
Specifically for highly granular stock optimization and demand forecasting.
So they're taking their operational data and using AIP to make predictions and optimize inventory in a way that legacy software just couldn't handle.
They're making highly complex, real-world operational decisions instantly. And we also saw multi-year deals with PwC UK to accelerate AI transformation across PwC's own client base.
Right. And the partnership with FTAI Aviation for engine maintenance?
Yeah, for highly optimized engine maintenance, this just demonstrates that AIP works across defense, finance, and industrial operations equally well.
And it's not just commercial. Their expansion isn't limited to that. We see new governmental doors opening internationally, like them achieving the IRAP protected level in Australia.
That's a big deal. That certification immediately opens up new contract opportunities in a critical allied nation. So while they dominate the U.S., they aren't ignoring global government clients.
Okay, so let's pivot from the operational wins to the financial structure, because this is really the bedrock supporting the whole investment thesis.
Yes, we always talk about quality of earnings, and their quality is absolutely top tier.
It's truly exceptional. Their gross margin in Q3 was, what, 82.45%? And the net profit margin was 40.37%.
And that adjusted operating margin hitting 51%.
Yeah.
For anyone listening who's familiar with enterprise software, those are truly elite margins. It just reinforces how scalable this model is.
Once the core tech is built, adding a new customer essentially translates directly into profit.
That scalability is essential because it directly addresses the how behind the valuation question, which I know we'll get to.
Oh, get to it.
They don't have to build new factories or significantly increase physical infrastructure. They just spin up another instance of AIP.
And beyond the margins, the balance sheet health is robust. They operate entirely debt-free, their liquidity is strong, a current ratio of 6.43.
And generating cash. They generated $508 million in cash from operations. That's a 43% margin. So they aren't burning cash. They're generating it very, very efficiently.
All right, but let's inject some reality here. Despite all that stellar performance, if we're analyzing this as an investment, we have to address the significant yellow flag.
You have to. You can't ignore them just because the top line is great.
Agreed. So the primary operational risk for me is concentration. Yes, commercial growth is accelerating, but 75% of revenue still comes from the U.S.
Right. And within that, the reliance on government contracts is still huge. Over $656 million in awards just over the last year.
Which introduces policy risk.
100%. Defense spending is subject to political cycles, shifts in procurement. I mean, if the U.S. government were to dramatically shift focus from AI modernization Palantir's sweet spot to, say, traditional hardware,
their pipeline could slow down dramatically.
Even if they execute perfectly on their current contracts.
And let's look closer at the working capital strain. So while the company has a lot of cash, their cash and equivalents dropped from $2.1 billion to $1.6 billion.
Okay, some of that is explained by investments in marketable securities, but the more critical metric for a high-growth company is accounts receivable.
That's the key metric you have to watch. Accounts receivable, so money that's owed to Palantir by its clients, it surged 75% to over $1 billion.
And in isolation, rapid growth often leads to higher AR, but a $1 billion figure means we're financing a significant portion of their own growth.
Exactly. If collection efficiency slows down, it means that phenomenal $1.181 billion in revenue doesn't translate into immediate cash. It introduces potential strain on their cash flow.
So you as an investor have to monitor that closely to make sure growth is actually being converted to cash, not just sitting on the balance sheet as an IOU.
And then there's the perennial complaint from shareholders, the dilution risk.
Yes. Stock-based compensation, or SBC. It's still a major concern. It totaled, what, $488 million year to date?
So even though management has tried to moderate it a bit, that level of equity compensation materially dilutes shareholder value.
Right. It means even if the company achieves fantastic net income figures, the actual earnings per share get dragged down by the sheer increase in the share count.
It's a structure that's common in Silicon Valley, but Palantir's history of heavy SBC means that shareholder returns require the stock price to run even faster just to keep pace. It's an uphill battle.
And all of these operational nuances, the AR surge, the policy risk, the dilution, it all leads us directly to the elephant in the room that you mentioned earlier.
The valuation debate.
Exactly. The stock has been a spectacular performer this year, up over 120% despite a recent, 22% pullback from its peak of 207.52.
That recent pullback was, I think, inevitable given the sheer height of the current valuation. I mean, the stock is now widely classified as significantly overvalued by most traditional metrics.
Let's lay out that disparity clearly for everyone listening. If we look at the price-to-sales ratio, the stock trades at 128.8 times trailing sales.
128.
Yeah. To understand the magnitude of that number, let's compare it to, say, Microsoft, a company with equally strong margins, massive cash flow, trades around 12.46 times sales.
Or even NVIDIA, the undisputed king of the AI chip supply chain.
Good comparison. NVIDIA trades around 33.3 times sales.
So the market isn't just pricing in a few years of great growth. It's pricing in decades of explosive growth and near-perfect execution without a single misstep.
That's the bet. This valuation suggests the market believes Palantir will not only maintain its current pace, but also capture a massive, commanding share of the global enterprise AI market and do it faster and more profitably than anyone else.
Which leaves basically no margin for error. Any hiccup, a delay in collections, a shift in government policy, a slowdown in AIP adoption could lead to a severe valuation compression.
Even if the underlying business stays healthy, that's the risk investors are paying huge premium to take on.
And what makes this so interesting is the total lack of consensus, even among the big players, institutional investors and insiders.
Right. Look at the insider activity first. Over the last 6 months, insiders recorded 349 sales and exactly 0 purchases.
0.
Now, we often see sales attributed to statutory tax obligations, like the $2.86 million sale by the CFO, David Glazer, but
the consistent volume of sales, coupled with the complete absence of any open market buys, it's often seen as a lack of confidence in the current valuation, regardless of the tax explanation.
It looks like insiders are executing planned exits at these elevated prices.
And yet, the institutional money is completely split. We see smart money funds reducing their exposure. Kingstone Capital Partners, for example, they removed 18.6 million shares in Q3.
So they clearly felt the risk outweighed the reward at that peak price.
But on the other side, other massive players are betting big. JPMorgan Chase added 18.5 million shares in the same quarter.
And UBS Asset Management was right behind them, adding 16 million shares. This is a genuine institutional tug of war. Sophisticated investors deeply disagree on whether this company is a once-in-a-generation AI growth story.
Or just a highly profitable software firm that got way, way ahead of itself.
So what's the synthesis here? Fundamentally, Palantir has never executed better. The AIP platform is demonstrably effective, it's driving historical growth, and it's translating into truly world-class scalable margins.
They're proving the business model works and can deliver GAAP profitability, no question.
But the investment thesis is defined less by their execution and more by the premium they command. The core debate is Palantir defining a new, untouchable category of mission-critical AI, justifying a whole new baseline valuation?
Or will gravity eventually pull that 128 times sales multiple back down toward the mean of its enterprise software peers?
The question you have to answer as an investor isn't about the company's potential, which is vast, but whether you're willing to accept the risk that today's stock price already captures all of that potential for the foreseeable future.
Right. Are you buying into the execution, or are you just hoping for an even higher valuation?
That leaves us with a final thought to mull over. Palantir's incredible growth is based on convincing companies, like that specialty paper manufacturer, that AI is not an IT project.
Right, that it's a necessary, immediate operational upgrade.
Exactly. So if they succeed in making this belief mandatory across all global industries, what does that mean for every other software company that sells incremental improvements instead of existential necessities?
If you enjoyed this detailed analysis of the execution versus the valuation, be sure to hit that subscribe button for more timely market analysis.